of the breakfast hospitality, which comes to you compliments of our friends at Cloverleaf Bank. Excuse me, and if I could ask Dennis Terry to just raise his hand. Thank you, Dennis. And also compliments of our friends at the Bank of Edwardsville. I know Tom is here. Tom, thank you very much. And compliments of the School of Business as well. We also have, and this is very important, we have parking is free until 10 a.m. So if you have a car here and you've parked, compliments in our lot, welcome, and we appreciate your staying. But if you stay past 10, and I know a lot of people like to linger, just be prepared to deal with the parking authorities as you leave. Seriously, we're happy to provide that complimentary for you this morning. We have a very diverse audience this morning, which includes many people representing regional businesses. We have many of our alumni here, many of our faculty, and several of our students. Chances are those of you who are from the business community have already picked out the students. But I wonder if I could ask all of our students from the School of Business to please stand this morning. All of our students from the School of Business. Aren't they a bright-looking, enthusiastic-looking group? Very, thank you. Thank you. These are the best and brightest students in the region. So if you are in the market for attracting talent to your companies, please just take the opportunity to say hello to our students this morning. We're here this morning to learn more about the vexing economic situation in which we find ourselves today, and hopefully understand how to find our way back to more liquidity and more prosperous financial markets. But constructing the path back to prosperity, or finding a different way to a different future, is fraught with uncertainty and controversy. And maybe controversy is an understatement. Yesterday's Wall Street Journal reported that, quote, the war over mark-to-market accounting is about to get hot again. And mark-to-market is just one of the policies that economic historians will look back on 50 years from now as key policies that either led us out of the crisis or made it deeper. What about the proposed Consumer Financial Protection Agency, or the status of international financial reporting standards? Is any bank or any business too big to fail? This morning's speaker is going to help us think through some of these policy alternatives from different perspectives. We're very pleased to welcome to SIUE this morning Mr. Arthur Lindo. Art is the Associate Director and Chief Accountant for Banking, Supervision, and Regulation of the Federal Reserve Board of Governors in Washington, D.C. You've probably already read about his responsibilities and his experience in the brief bio that we distributed this morning, so I'm not going to cover them again. You're here to listen to Art speak, and he is going to speak for about 15 to 20 minutes, and then we'll have some time for some discussion and questions and answers until, hopefully some answers, until about 9 o'clock. So without further ado, let me, please help me welcome to the podium Mr. Arthur Lindo.
Well, good morning. I find it odd that so many people would be interested in accounting at 7:30 in the morning, but since you're here, I'll talk a little bit about accounting. To start, I have to make the normal disclaimer. These views are my own and don't necessarily reflect those thoughts, views, or aspirations of the Board of Governors of the Federal Reserve System or its staff. So with that said, the official part of my work is out of the way. I'd like to talk to you about a few things. First of all, I'd like to thank Gary and Greg Sierra for inviting me to come to speak. I get invited to speak to different venues, but I rarely get talked to about speaking to students and about those who will be crafting the future of accounting, and so this is a welcome opportunity. I've done recruiting for the Federal Reserve in the past, and I've always found it to be joyous to talk to the people who are thinking about a career in accounting or in finance. So I think personally, it's a good choice you're making. I think financially it can work out for you, and the bottom line is it's a brave new world and a whole lot of possibilities in front of you, particularly as a result of the crisis, which is where I'll start. Again, I'd like to limit my remarks so I can get the maximum amount of time allotted for Q&A. I think that's the most enjoyable part of these sort of things, taking the questions and formulating what I think is an appropriate answer. But a little background might be useful to frame the discussion. When I think about the crisis, and what crystallizes in my mind as the epitome of what went on, is I think about my basement. You're going to say, what's so great about your basement? Well, it's a finished basement, but that's neither here nor there. The issue was where during the height of the crisis, we were working basically 7 days a week. And on weekends, you didn't have to be physically in the office. We have telecommunications, as you can imagine, just like other parts of the country, and so you could take the call from wherever you are. So invariably in my household, I would be in the basement because that's the one part of the house that's generally quiet to begin with. It's secluded, and to the extent that there's noise, it's normally the laundry, which I can cut, wash or dry, I can cut that on and off. So it's my little sanctuary in the house. So I'm in the sanctuary, and during the height of crisis, I remember logging on to a typical phone call, and the list of individuals on the phone call, if I were to name them, would be kind of a who's who you've seen in the paper. So here's me, accounting expert Art Lindo on the phone, and I'm used to, by this point, being named as the guy who causes the problems, namely because invariably, as we started thinking about ways to account for assets and get out of the crisis, some of the suggestions would be, why don't we just sell these assets into a trust? And the trust would hold the assets into a future period of time where things recover and the asset values could be realized. And I'd be the guy who raised my hand and said, well, if you did sell them into the trust, what price would you actually offer the trust to buy them? Well, they could just buy them off the bank's books at what the bank has them as. I said, well, that's probably not going to work because, and I'd go ahead and talk about fair value accounting, and I'd be the deal breaker, be like, all right, fine, let's try another approach. Well, let's try this approach. We'll put a wrap around these assets and we'll guarantee the future value of these assets, and that guarantee will be booked as, or be the buffer, if you will, to make up the difference between the then carrying value of the assets and their fair value. And I'd be the guy who says, well, if you do that, then you may have created a derivative instrument and you'll have to record that at fair value, this is that. And you can imagine this thing went on, and so I'm sitting in my basement, and I used to dread getting on the calls because I'd be the guy who says, that's an interesting solution, but it's not going to work because. And throughout the crisis, we'd gotten to a point in thinking through this, and I said, well, what are the fundamental concerns that we do have? We have asset values that are somewhat depressed at the moment. They may not actually reflect the true value that will be realized over time, and I'm constrained by the fact that in accounting parlance, I have to record these at either a fair value or an amortized cost that reflects what I ultimately expect to collect on these assets. So as we worked through this, a few things became evident. When we talked about the valuation of instruments on a typical bank's balance sheet, we were talking about securities and we were talking about loans, which for the average bank is more than 70% of their reported assets. When we talk about the valuation of securities in particular, it's generally a market notion, what you could get in an active market, willing buyer, willing seller, from the perspective of what the market participant would pay you for those assets. Not necessarily what you think they're worth, but what you could actually get, which is a concept that in most senses of the term, you think you'd have a meeting of the mind. Well, there are a few things that were going on in the market, as you very well know, that made that proposition of a willing buyer and a willing seller a little bit challenging to meet. One was liquidity. And when we think about liquidity, we typically think about, well, I have some assets. I could go, if I wanted to sell them, I could sell them today. I can convert them for cash. When we think about liquidity on the liability side of the balance sheet, we think of things like, well, I have some liabilities that are due in the next 6 to 8 months, 6 to 12 months, whatever period of time you want to use, and I'm going to have assets that I can convert to cash to pay off those liabilities. Well, those sole propositions, what I could pay off liabilities for and what I convert assets for, were in doubt because the markets were acting in such a way as to say, well, if you were to try to sell those assets today, even though what you might perceive as a value as being 100, I'm only going to give you about 75 because I'm uncertain about the future prospects of the cash flows backing those assets. And so we had a situation where the intrinsic value of the assets weren't actually being captured in terms of the marketplace. Okay. Well, the organization that I work for prides itself on making sure that we have, in one sense, liquid markets in the United States. And so we were prepared to pump in enough liquidity in the system to make as much of that go away as possible. And we did that to unprecedented levels over the past 2 years. And so that was, at the time, one of the things we weren't actually thinking was necessary, but ultimately became a reality. So again, as we worked through the crisis, not only we had to look at the value of those securities, but how they would be converted in the marketplace. Not only we had to look at how loans were carried, but we had to look at what they'd ultimately be realized at. So let's turn to loans for just a second, and we're going to circle back a little bit later in our discussion to talk more in depth about loans. You had a series of loans in the United States that were backed by, in some cases, commercial properties. Sometimes they were backed by business operations. And in the cases of consumers, they were backed by mortgages, which we all know at the present state in our economy, we're a little bit on the recovery side still. So all of the values backing all these assets were in some sense in flux. Given the fact that from an accounting perspective, you look at assets at what you originated them for, and then you make adjustments along their life to reflect what they could ultimately be realized for. So if you expect to have a certain amount of credit deterioration in your portfolio, under our current accounting model, you account for that as you move forward through the economic cycle. You don't, in essence, do that up front, as to say that over the life of this arrangement, I'm expecting a tremendous amount of losses, so I'm going to record all those losses today, which may have been optimal in this past environment. Why do I say optimal? If, in fact, some of the angst, if you will, around valuations were because we thought they were carried on their books at a value in excess of what they could ultimately realize, wouldn't it have been better if we sat back and we said, well, looking over the life of this arrangement through growth in the economic cycle and a trough or two, so we have one full representative cycle, we expect to collect 95 cents on the dollar. If in fact we had the assets booked at 95 cents on the dollar and there was a 5%, if you will, allowance set aside, we may have felt a little bit more comfortable about that. But because we were in a market where we're thinking, well, maybe we've only got the assets recorded at 97% of their value, and ultimately we're going to lose another 2, 3, or 4%. The angst around whether or not that was captured in the valuation caused a number of things to happen in the marketplace, none of which were positive. And to that extent, there was a certain amount of pressure being placed on asset values and the recording of those in the accounting sense. All right, so that's what was going on the loan front. Add to that, although we have, in terms of disclosures, probably the thickest package of disclosures ever, all right? If you look at the standard 10K or 10Q disclosure and you add on to that the amount of information you can get through analyst calls, we've got more information out there than we've had in our entire financial history. Yet, in spite of all of that, there was still this angst around whether or not those assets were properly valued. You know, and then sitting in my basement one day taking a call, I was thinking about this, and I said, you know, we keep hitting the same obstacle every time. No matter what we do, how we present this as a package, we're still stuck with the fact that there's a certain group out there that's saying, you haven't recorded all the losses that are in the portfolio. And so we struggled with this for a bit, and the solution became painfully evident. And that is, what if we took sort of a draconian view of this? We looked across the entire sector of the economy, and we said, for this sector that there's a whole lot of question and doubt about the realization of assets, what if we just said, on the worst case scenario, the maximum you would lose is X. We disclosed all the parameters around that, so all the information that we used in our assumptions were readily available. Would that relieve the angst around asset prices? And we tried it, and it turned out to be what in the Federal Reserve we called the S-cap. And what we did is, for a large group of, or an institution that had a large footprint, we took a group of them, we grouped them together, looked at the loans and the securities, and we took a view. We said, if an economic downturn of significant severity occurred over a prolonged period of time, which happened to be 2 years in our analysis, what would the asset values be at the end of that 2-year period, and how much additional capital would an organization need in order to weather the storm? And when we did that, that actually had a calming effect on the markets, so much so that there was a little bit of price discovery that occurred after that. That is, assets were sold and the market started to unfreeze. So in that one exercise, we saw that even though what I call accounting should report the news, it shouldn't be the news. accounting had effectively become the news. How you valued assets was the talk of the town. And when we did the SCAP, that took a lot of the pressure off of it, asset values, but we still have nonetheless some lessons that we need to implement for the future. And what are those lessons? Well, in terms of valuations of loans and other securities, the current accounting model obviously is somewhat flawed. We have securities that are carried at fair value. Some are carried at fair value through the income statement. Some are carried at fair value through an adjustment through stockholders' equity. And then we have some that are on a historical or amortized cost basis. Well, the debate that's going on now is whether or not we should keep all of those securities at fair value, and whether or not the bifurcation should be between the income statement and other comprehensive income, the separate component of equity, and should the standard be whether or not you're trying to hold those securities for a return on contractual principal and interest payments. And so if you're holding it for yield, then you don't run it through the P&L. If you hold it for something else, you run it through the P&L. So that's what's going on with securities. For loans, the debate is whether or not loans should be at a fair value basis. And in that regard, what's a little bit daunting is that we don't have a history in the United States of valuing loans at fair value. And it's not exactly that loans get traded, as you know, on a day-to-day basis. What loans may be is packaged, securitized, and the securities that result from those, that process are sold. And so that's what trades in the market, not the underlying loans. So the idea that I could come up with a comparable price for an asset that's unique in its characteristics, irrespective of who holds that asset, is what we're talking about today. Now, the solution there being, if in fact we could come up with a fair value, we won't have the problem that we experienced in the past. Well, I'm not so sure that proposition holds, because what we experienced in the past was largely driven by credit factors. Whereas when you look at fair value has a credit element, it has a liquidity element, it has a market yield element. And so when you add those other two, and I'll even throw in an other, because sometimes you don't know why fair value moves, and even the best of our economists can't put their finger right on it. So credit is only one of those components. Historically, we've only looked at credit when we valued loans that are held for investment or held for the foreseeable future. So this would be a big change and departure. So as we're coming out of the crisis, some of these issues are now at the forefront, and as Gary alluded to, that's where the debate is. Now, internationally, we've already heard what our counterparts in Europe and counterparts in Asia are doing, since they use international financial reporting standards. And in that capacity, they're going to have a model that allows loans to be carried at amortized costs and securities to be carried at amortized costs, debt securities, I should be clear on that point, if in fact they meet certain characteristics, namely that the business model of the organization that is holding them, the business model is to hold for contractual principal and interest payments, or otherwise yield. And so with that in mind, if that business model is in place, then you could carry them at amortized cost. And that's obviously very simplified the way I put it. For any other purpose, you run it through the P&L on a fair value basis. So that's what internationally done. Domestically, we're now just starting to have that debate. And the debate will be rather fierce. On one side, you have the fair value advocates, which is everything at fair value. On the other side of the aisle, you have advocates that think the international model of a mixed measurement attribute, some at amortized cost, some at fair value, is the appropriate measurement technique. So that's where we're going, okay? And with that in mind, I'm looking forward to that debate. We participate on it in a real-time basis at the Federal Reserve, and so being part of that, it's a fairly exciting time to be an accountant. So much for the crisis in terms of, some of the big drivers. We're looking at valuations of securities and loans is what I wanted to leave you with. Let's transition a bit into supervision. That's how we look at institutions from a standpoint of determining whether or not they're operating in a safe and sound manner. And that's important because, in fact, if we find that an institution is not, then we normally move towards certain corrective measures, some of which may mean the actual closure of these institutions. And in that regard, just to give you a lay of the land, at the Federal Reserve, we have domestic organizations that might be called state-chartered institutions. These are banks that have a charter issued by a state and that are members of the Federal Reserve System. Of the 7,000 banks in the U.S., roughly 10% of those fall into the category that are state members and regulated by the Federal Reserve. We have a larger group of banks that are called national banks. Obviously, they have a national charter, and they're regulated by the OCC. And they're about 21% roughly of the 21, why don't we round it up to 25% of the banks in the nation. They tend to be the largest banks, if you will. Their charter and their focus is a little bit more than the community-based charter that you find that most of our state banking organizations have. So, and that group is regulated by the SEC, but as you'll see in a moment, they may be in a holding company that the Federal Reserve is responsible for supervision of. And then the last group that I'll just mention are state non-member institutions that are regulated by the FDIC. They tend to be the largest in number, but they're generally smaller community banks in focus. And so with those three groups primarily, we've covered the span. So I'm leaving out credit unions for a moment, and I just wanted to paint somewhat of a picture for you. And that is the supervision of these organizations in light of the crisis. One of the key drivers that continues to remain is the assessment of credit risk in their portfolios of loans and debt securities. And to that extent, I think you will see some change in the not too distant future, not necessarily just because our examiners are out there, but because what we're seeing in terms of practice is an evolution in terms of credit risk management. Where in the past, maybe we looked at very static values. I think with this 70-year loss event, we're going to have to take a different view. How credit spreads can widen, how credit spreads can change in a short period of time. So I think with this under our belt, you see that being factored into our assessments. Now, there's a lot of commentary and criticism on whether or not, from an examination perspective, we are in fact causing the problem because maybe there's a knee-jerk response. Maybe some of our examiners are going out and being a little bit too aggressive, if you will, and taking a view that just because losses have reached a certain point that they're going to continue. And that's a concern that we have at the Fed. And I think personally, the training sessions that I'm involved in, as well as the recaps of our recent examinations, kind of a review process we go through, our evidence is that's not the case. Our examiners aren't making the situation worse. But you wrap that in an environment where we're talking about keeping homeowners in their homes and a certain amount of forbearance on the government side, if you will, the Treasury putting out guidance that will say we'd like homeowners to be in their homes for the foreseeable future, and as such, we're making reasonable accommodations. Messages such as that, I think, are a little bit difficult for our examiners to initially assimilate, and that what we're being told is to forbear, but we're not being told to forbear without rational justification. In other words, if loan workouts are not viable, our examiners aren't getting a message to continue down that path or encourage institutions to do. However, where those loan workouts are very viable, our message has been relatively clear in that we should encourage banks to do that. Now, once I've said that, there's still yet an accounting outcome when you rework these loans. If these are troubled debt restructured loans, then there's likely to be a mark on that individual loan, and it has to be evaluated for impairment on an individual loan basis, which is a big change. If you've got a portfolio of 1 to 4 family loans, typically you've looked at this from a historical standpoint, you've looked at this from a statistical measure. You've determined that on the pool, I'll have X percentage of losses, and that as losses occur, realistically, I'm not going to analyze each one of these individually. I'm going to effect a foreclosure, if in fact one's necessary, and I'm going to work that out. And this over time has been what we've done in the consumer portfolio. But with the advent of the volume of restructured transactions and the requirement from an accounting standpoint to evaluate each one of these, that's put more strain on the system that had been there previously. So the individual evaluations of loans is really what the log jam is. You can't actually just do that on a pool basis, which our examiners are working through with the banks that they supervise. So in terms of, so far we've talked a little bit about what's going on in terms of domestic supervision. And international supervision, we work with the Basel Committee, what would be called the international banking community, if you will. And in that regard, we're making sure that what our measures are, corrective and otherwise, are consistent with what is being discussed internationally. Not that our model in the U.S. has to be exactly the same, but we'd be naive, in fact, if we ignored what's going on internationally. So there's an entire separate work stream to make sure that our capital measures, our credit risk assessment measures, our liquidity measures, All of those measures that we use to determine whether or not an organization is operating in a safe and sound manner are consistent with not only just what we think is appropriate here in the U.S., but to benchmark with our colleagues overseas to make sure we have a level playing field. So in terms of supervision and safety and soundness, that's really been the focus coming out of this crisis that I'd see. I just wanted to turn briefly to this whole area of the allowance. And this is a little myopic, I recognize. And in terms of the allowance, historically we've just said, well, wouldn't it be great if we had enough set aside, or at least let me put it in perspective. Under the accounting model says, well, when you're determining what you're going to collect on a loan, you look at what you can reasonably estimate and what's probable. And so what we believe has occurred is, as a result of this crisis, is that particular standard, the probable and estimatable standard, hasn't worked in practice. At the beginning of the crisis, we had what we thought were adequate levels of allowances. Well, we've eaten right through them, all right? And therefore, when you look at the predictive quality of a model, every once in a while, my economist friends tell me that you have to true it up. You have to compare that to actual behavior. So a model is only as good as its predictive quality. In terms of the accounting model for the allowance, I would think we're well overdue for some sort of revision. Now, back in 1999, our colleagues over at the SEC looked at one of their registrants, it happened to be a bank we all know, SunTrust, and said the amount of allowance that you have set aside is excessive. It doesn't represent what you have articulated in your management discussion and analysis as an appropriate measure of credit. In fact, it's much larger. It's multiple times that. And at the time, up until that point, even though we would work with the SEC, we hadn't heard much about too much of allowance. In fact, most of us thought it wasn't objectionable, at least from the supervisory side, to have a little bit extra for the rainy day, right? Well, in 1999, when the SEC clarified that you can't have this rainy day amount, a number of us on the supervisory side got a little concerned, but we said, all right, we've decided to follow GAAP. Let's go through this process and make sure that it works, but we're going to give it an opportunity, and we're also going to put the rigor of our examination process behind it. And with that in mind, we went through, you know, the early part of the decade, and now that we're at 2010, I think the results are clear. Probably a little bit of a cushion is a good thing, okay? Now, how do we do that in an accounting sense? Because investors are torn with the fact that they want to evaluate management performance. They don't want to do it in a vacuum, and they don't want it done in an artificial manner. In other words, they want to evaluate management for the judgment that they bring to the table and the success for which they operated the organization. And in the area of the allowance, what we're going to do is look at a broader perspective. We're not going to look at just what's probable and what's estimatable, because that has given us sort of a short-term view. We're going to look at what we expect to collect over the entire life of that arrangement, given certain variations in what we think are likely to occur in the factors that lead to collectability of a loan. Unemployment, for example. If, in fact, you can project the current employment rate and say it has this effect on your loan balance, what do you over time think it would have? Likewise, economic output and productivity. So we're talking about measures such as that being factored into the assessment of an allowance because we think it needs to be more robust. We need to have more of an expected loss, what we in a forward-looking way and manner think would be ultimately achieved in terms of the recovery of those assets. And you know, that's very tension-oriented, because on the one hand, you have investors that don't want smoothing of earnings, want to evaluate management. On the other side, we've got this now 70-year loss event. How do we factor that into our analysis? Could another event like this happen? Could we see asset values drop? Could we see a worldwide reduction in productivity occur to the point where we would have some question, a severe question about the collectibility of assets? Well, since that day is here now and we're dealing with it, it's an appropriate time to revisit this model, which is what we are doing, both here domestically and globally. Now, globally, the view has been more along the lines that we should take an expected loss approach, which again looks out over the economic cycle, takes into effect matters that can be reasonably estimated. Okay? You're not just limited to an observable event has occurred, therefore I have a loss. So you don't have something that goes into default, or you don't have a late payment, but you anticipate these things. And with practice, we've gotten better with it over time. So that's fairly promising coming down the horizon. Some of the obstacles to that, obviously here domestically, we like what the system has been in terms of certainty. It's easy to audit, okay? I can actually point to, I had a certain number of days delinquency in my account. I had certain charge-offs over a period of time. The auditors could look at that and say, based on objective measures, those things have occurred. The more we get away from those objective measures, the more angst, again, you'll see in the system. And so if it can't be audited, why do we do it? Why not just guess, you know? And so there needs to be something in between there, a guess that's unsupported and something that actually has to have occurred, i.e. a default on a particular asset in order for us to record an allowance. And that's where the debate is currently. We're hoping we'll get more along the lines of estimating it based on what we expect to see, as opposed to having a default occur and then you record allowance. Because as we all know, having a default event occur isn't the point at which the loan became uncollectible. The loan became uncollectible possibly because of loss of a job that occurred, you know, several months earlier, or a closure of a particular economic activity, or a reduction in an economic activity. So in terms of the timeline, what we call as a loss event, the trigger, if you will, occurs several periods before the actual manifestation of a default or delinquency. And somehow bridging the gap to say that those default events, or triggers if we call them, once we see any indication of that, we want to start setting aside amounts to capture that loss at that time, as opposed to, you know, in the heat of the battle, if you will, when the cycle is in a downturn, recording additional losses further exacerbates the problem. So one of the key lessons out of the crisis is that we will have to recognize losses sooner, and we'll have to recognize losses over a longer time horizon, not just what might be the foreseeable 12 months. And so with that said, there's a lot of thinking going on behind that. And some of the groups that I personally participate in, which have some fairly smart people, not necessarily myself, but the group there is going through a lot of statistical measures, and from a scientific standpoint, it has some rigor. Now we're going to have to make even all of these sort of statistically based models operational, which is going to be a good challenge, given the fact that we have, not every organization in the United States has, you know, 50,000 employees as some of our larger banks do. Most of these are community banking organizations. So we're going to have to bridge the gap in the final analysis between the mega banks, if you will, and the community banks to make whatever model workable in both environments. Namely to say, maybe the flavor of an allowance model for a community bank is a little different than the flavor that we use in a large bank, but the outcome should be the same, something that's edible in my case. So with that said, we've touched on what I thought was the third topic we had time for this morning. Is that the allowance, the direction of it, what our views are on it. So at this point, just to summarize, the crisis, you got the view from my basement. You know what it was like down there. It's a very comfortable room, but there's a lot of heat. And when we looked at supervision, we talked about, are there disparities between where our examiners look at community banks today versus community banks yesterday, if you will, or pre-crisis, how we look at large banks. I mean, our view's pretty much the same, but we do have to take into account the fact that there are a number of government programs and there are a different environment where we're working with borrowers, and that's our ultimate goal, is to maximize the return to the banker. And so with that in mind, there's a little bit of flexibility. If you're hearing or seeing different, I'd like to know that, but nonetheless, we'll get to that in the Q&A. And then finally, the future of where we're going to go in terms of what are the key lessons learned, at least in the area of allowance. I mean, we can't be backwards looking. We just can't say because we've historically only had this small loss rate that our current underwriting and our current practices will produce the same sort of losses going forward. We're probably going to have to open it up a little bit and be cognizant of the fact that these are all estimates, and as estimates you have a margin for error that's built into most estimates, and that as we look over the horizon, we probably have to anticipate not only the growth spurts that we've had, but the downturns in the economy as we're currently experiencing, and come up with a rate, if you will, for setting aside losses that takes all of those factors into account and gives us losses over a horizon that's potentially longer than what we've been comfortable with in the past. which may mean, not to pick on my colleagues at the SEC, that we have to revisit our thinking in terms of what a public registrant would disclose as well. Because maybe there is, again, this 70-year loss event that some of our publicly traded companies do need to factor into it. And I'd leave you with this thought. In the pre-crisis days, we had a number of disclosures that were made by publicly traded companies on their portfolios, both their securities portfolio, loan portfolio, their trading portfolio, if you will, and the volume of disclosures around that were tremendous. You add that to the analyst calls where all this information was readily available. And the thought I'd like to leave you with is, are we getting the right information? Because if all of this information was readily available, how could we have missed what was the most severe economic downturn and lapse, if you will, in credit judgment that we've seen since the 30s? And with that in mind, you know, the batch of disclosures that we come up with going forward, I go back to, again, what the Federal Reserve did with regards to the SCAP. In that exercise, the most daunting thing was when we decided to disclose the approaches that we used, as a lot of people say, oh, that's what you did. And the odd thing about it is any set of disclosures that a financial organization produces should answer that question. What did you do? And so for me, I leave this with a question. And again, and that is, even if we fix the accounting, we have to deal with the disclosures. We have to deal with the reality that not all of us interpret this information in the same manner, and as a result, there might be differences. Those differences might mean I'm not interested in paying a certain price for an asset value as opposed to someone else. And to the extent that all of the information is available, you should be able to deconstruct portfolios and build them up in a way that makes sense to you and make valid and supportable decisions on asset valuations. And so I just think we need to think about that a bit more as we go forward and make amendments to the way we supervise, the way we invest, and the way we behave personally. And with that, I'm going to suggest we pause, Gary, and maybe I can start taking a few questions from the audience.
We have microphones on both sides of the group, so if people have questions, please approach the microphone.
It might be a little outside your bailiwick, but I see that one of the real weak links in the whole chain as part of that securitization process was the credit rating agencies, Moody's, S&P, and those three leaders really don't appear that they've really been drug over the coals very much, and I think they're supervised by the SEC. Can you comment on that?
The rating agency's role in the crisis has been one that we've talked about, and to a great degree, some of our supervisory processes depend on what ratings are given by these agencies on the external debt, if you will, of some of the firms. What was obvious during our postmortem of this crisis is that maybe there was undue reliance on the rating agencies, somewhat to the extent that you look at, for example, compensation, and this may not be the most significant driver, but rating agencies are paid by the issuers of the securities that they rate. And as a result, you know, one might say there's a little bit of bias in that. Beyond just the actual compensation given to them, what rating agencies look at are often models that are, again, developed by those same groups in order to estimate the asset, the cash flows on the underlying assets that will be ultimately collected. So again, you do have a certain amount of interdependence of the two. Now, should the rating agencies be totally detached from that process? Well, obviously not. They don't have, they need to have access to the data in order to make these judgments. Do they need to make their own independent assessments? Yes. Are the lessons that they've learned from this process such that when they give a AAA rating on a group of securities going forward, will it have much more rigor? I would expect that it would. Will it have the type of rigor that we could blindly rely on? I would say no. And I think the lesson to be learned from an investment standpoint is those are just ratings, those are indicators. If in fact you have fundamentals that indicate that those values are questionable or not supportable, then you should make an investment decision based on that. So I would not just say that the rating agencies need to and are in the process of looking at how they rated these securities and what they're going to do differently going forward, but I think from an investment standpoint, the appetite for, if you look at the typical investment policy of a financial organization, it will read something in the following. It will be like, we, the board, or the asset management committee, authorize management to invest in securities of a particular grade, okay? Anything that's AAA, that's fine, okay? That level of reliance has probably seen its days and past. Now we're gonna move into an environment where those investment strategies will not only just say whatever rating agencies, but there's gonna be some internal rigor around that investment decision before funds are advanced. That's what I would imagine will come out of this as we look at not simply what the rating agencies are doing differently, but we from the investing public, whether or not you're an institutional investor, whether or not you're a private investor, you'll be looking at this with a little bit different view as well. So I think there are lessons to be learned there. As far as the SEC's regulation of rating organizations, I can't really speak to that. I know they're doing some things there, but I can't say that I have any personal knowledge of what changes would be made there. So, okay, let's keep the questions coming. You've had your breakfast? All right.
You mentioned you think the accounting model needs to be changed. What's your view? How well were the banks following the accounting model that was there?
Oh, okay. A good point. Now, when I talked about the accounting model, I mentioned two elements of it. I mentioned fair value and I mentioned amortized cost with some sort of impairment around it. To the extent that fair value was being utilized, the observations that I would bring is where there was a market mechanism, either you were a large enough bank to have your securities be, the securities that you invest in priced from an internal source, I think there was a lot of rigor around that. If you were a bank that relied on a third party, a vendor to provide you with prices, what we found during the crisis is that you were totally relying on that vendor. And so if that vendor did not provide you with value, you were up a creek. Going forward, what I would imagine needs to be done is that you won't have that level of reliance on the third-party vendor. You will have to develop some sort of internal metric in the event that that vendor cannot provide you with that, or you realize that that vendor's price is just a matrix price, something based on somebody else's value, but not a true assessment of value. So I don't think in terms of the securities area, I would give us a very high mark. I would think that we were totally reliant on external sources, whether or not that was a vendor or a quoted price. And when we found that markets became a little liquid, you couldn't get a new price, there was an inability to value those securities. Okay. Securities is possibly the easier part of the two. When I look at loans, interesting enough, I think the model, the accounting model looks at basically your historical losses, and you adjust those historical losses for current factors, and those current factors are what you use to augment things like changes in the economic cycle. Well, on that one, could you have anticipated the 70-year loss event and the severity of which your individual portfolio would have been impacted by that? And on that score, obviously, we weren't terribly successful at that. So do you blame the accounting model? Or do you blame the application of the accounting model? Well, let's look at both. The accounting model, as I said, was more historic or backwards looking. It looked at, well, when I've done C&I lending or CRE lending or consumer lending in the past, the most I've ever lost has been so many basis points. And so that's what you booked. That's what you looked at. You said, my underwriting hasn't changed significantly. The exposure, my concentrations haven't changed. And so if those factors were constant, you probably set aside the same amount of allowance that you had historically. And that was viewed by auditors, by, to some extent, the preparers, obviously, and to some extent, even the supervisors as being adequate. Well, now you factor into your historical data set a 70-year loss event. That's so severe, you've blown out all of your loss estimates from the past. Okay, now, you know, the accounting model has to take that into account, and the accounting model now will do that, the existing model. But given the lessons learned, do we always want to be looking in the rearview mirror, or do we want to look through the windshield? Because we're driving in this direction. And if our past experience is an indicator of what we can expect in the future, it should only be one factor. We have to open up our thinking and say, what is it that we've done differently? Is our underwriting tightened? If our underwriting is tightened severely and we're not making as many loans, one, you're not going to have any yield, but you know, aside from that, you're probably not going to have the same loss expectancies you had in the past. All right? Now, during this part of the economic cycle, lending tends to tighten. Standards are, if you know, more rigorous, and so we're probably making the best loans now than we've made in the last 10 years, all right? But we're not making that many new loans, which is a separate issue. Now, going forward, therefore, I'd expect fewer losses, but with this historical focus and our view, now we should be opening it up and not just looking at what has historically been the case. The accounting model now has to, in my view, embrace some other view, not just historical losses, which means how comfortable are we with estimating cash flows going forward for a group or pool of assets? And if so, how much variability will we find acceptable in that? And that may be an area of discomfort for most, because remember I used the SEC example with SunTrust. SunTrust said, well, you know, we wanted to be a little bit more forward thinking. If they didn't have the data points to support it in the past, the view was you couldn't book it. So we may not have all the data to support our best estimates of losses going forward. We will develop such data over time, but I think what we're going to have to embrace is a model that allows for a little bit more forward looking, and that's different than what we have today. And the second element there is how we apply the model. There are always going to be individuals who push the envelope. They're going to be possibly more aggressive than others. They're going to be possibly considering things such as managing earnings. I would probably, however, put those in the minority. We can't write accounting standards for those that are to ward off the most abusive cases, which sometimes is our thinking that, oh, we're concerned about management of earnings, and because of that, we can't allow you to do forward-looking projections, because if you book that, you'll be able to smooth earnings going forward. Well, smoothing earnings is one attribute, if you will, with estimates. But in and of themselves, estimates have a certain amount of uncertainty assigned to them. And with that in mind, I think it would be naive to say that we should simply stay away from estimates because they have uncertainty built into them. Well, I have uncertainty with every element of my life, if you can think about it that way. To some degree, I'm comfortable in my employment, but you know, and looking at what's going up on the Hill, I don't know when I get back to D.C., that prospect, my future, would have changed. And so there's a certain amount of uncertainty we all deal with. We internalize it, we deal with it in many different ways. So I think, again, if we look at the model, I think the model has to change, and I think we have to give a little bit more deference to those who apply it. Maybe everything would not be something that we can audit to the extent of having a objective set of evidence that we can turn back and say, aha, the reason you came up with that best estimate of cash flows was based on historical. We may not have that. Some of them are going to be judgment. The banker in his or her judgment believes they will only collect this amount and want to set aside dollars for that. Now, again, if we have hard data points, we'll be back where we were in the last decade, playing catch up. But if we open this up to address factors such as the use of judgment by skilled professionals, I think we're going to go to a point where I think we'll be a little bit more comfortable. But that's going to be an obstacle. There's generally been reluctance to allow judgment to be used in the past, as I've indicated, at least in the case of one bank. Judgment wasn't viewed favorably, at least from the standpoint of a securities regulator. A few more.
In your opinion, how effective have the banks been in cooperating and providing programs to their borrowers to actually keep them in their homes when those homes are so far underwater? Adjustment of just interest rate alone doesn't seem like it's going to be effective in the long term. It would seem to me that ultimately that house is going to have to be revalued, some write-offs taken, et cetera. And everything I read is particularly the large banks have not been very cooperative in this area.
Okay. Very politically charged question, and one that I will delve in with a certain amount of delicacy. This is probably a good point to say these are, again, my views and not necessarily those of the folks that I work for. In my opinion, okay, so just to reorient the ground rules. This question comes up often. In fact, I got a letter from congressman, well, I don't get these letters. They go to the chairman of the Federal Reserve and they end up on my desk, asking this very question. And the question was along the lines of what you put into play, but there was another dimension. Not only were the banks that hold the first mortgages being told you need to restructure them, but there's another group of organizations out there, some of which are represented by the same financial organizations, that hold second mortgages on these properties. And there's an interesting dynamic that occurs. If you have, and in the US, typically second mortgages have been used much like credit cards. And it's a line of credit. It's something that, if in fact, I look at some of the programs that we have up and running, they're directed toward the first mortgage, and they're saying to the banker, the servicer, provide some relief. But they don't take into account that from the borrower's perspective, one of the elements that the borrower has to do is to focus on the fact that you have to be in some distress on your first. So that's made consumer behavior a little bit interesting to watch, and that is to someone who has a legitimate problem meeting their first mortgage. You know, they're not paying as agreed, they're behind. They may actually have a second mortgage that they're current on. And the reason they're current on that second mortgage is because it's used more like a line of credit. And to the extent that that line exists, you have this tension between the first and second mortgage holder. The second mortgage is actually current, paying as agreed, and a banker would not, under our current accounting model, and not to belabor that point, they wouldn't take a write-down of that particular mortgage. But if I looked at the first mortgage, the first is delinquent. It's supported by collateral value that's severely diminished in terms of being able to satisfy the recorded amount on the book. So you'd suspect there'd be some impairment there, some write-down. So in this one case, in order to take the write-down, you really have to look at it from the standpoint of the first mortgage holder is not going to take a write-down to the extent that's going to compensate, if you will, the second mortgage holder. So I'm going to forgive debt. I'm going to forgive debt on a property that's maybe worth 70% of its previous value. So I'm going to take a 30% write-down. On the first, if I take that 30% write-down, then in essence, I have a real loss, okay? I'm transferring value to a borrower. The borrower, in maybe some sense, is not being held accountable for that contract, which presents a little bit of a moral dilemma because most of us in the U.S. think that you take out a loan, you repay it. That's the way our culture works. To the extent that we are giving or encouraging someone to forgive a debt, A, it's taxable, but then B, looking at it, there's a little bit of an issue there. But now let's get back to reality. Those asset values were probably grossly overstated to begin with, okay? We were in an economic upturn that was unsustainable, as we very well know now, and as a result, maybe we made loans to support for assets that would not actually be recoverable over time. So somebody has to take a loss. Most of the programs that I've seen, you know, Treasury tried a number of different approaches, have not been largely successful, in part because of this second mortgage issue, in part because I think this moral dilemma we have that we're going to forgive a certain amount of debt. And, you know, the banks themselves are not in the position of going back to shareholders and others and saying, you know, we made a lot of these bad decisions. They're okay with the prospect of setting aside a reserve for that. There's a little bit of reluctance on just forgiving the debt all said and done. This is, as you can imagine, up on a hill, a very, very sensitive issue. So much so that, you know, the letters that we receive from the regulatory standpoint are your examiners enforcing this? And to the extent that we've seen loan restructurings, we've supported it from the standpoint of saying, does it make economic sense? If you restructure a first and a second so the borrower can make that payment on a fully amortizing basis, then that makes sense. If you restructure it and the borrower still can't, then it doesn't. And so we haven't supported programs that don't get you down to that, but that will require both a first and a second mortgage holder to work jointly. The second mortgage holders, as long as that second mortgage is performing, have really no incentive to work with the first. Now, the moment that those lines either reach their maximum or the borrower starts to show signs of deterioration in credit quality, you may see more of an effort to work together. But there's no easy solution to this. If I were to simply say blame the banks and they should be forced to charge it down, then let's think about the next step. One of the things the Fed does is actually try to think through how these sort of policy changes will affect economic growth and recovery. And so to the extent that a bank's taking more than what it would perceive to be its fair share of charge-offs, it's probably not going to be generating new business in that area. And so there's a counterbalance here. We can't necessarily give away value or encourage banks to give away value. We have to encourage banks to make responsible financial decisions and look prospectively to the future to make additional loans based on real signs of improvement in the economy. So there's not an easy answer to it. If I could blame the banks, that would be an easy way out, but in some cases, some of the programs I've seen, they haven't taken off as quickly as we would have liked. And although the Treasury Secretary is repeatedly looking at alternatives, and from a policy perspective, all of the agencies in the U.S. government are looking at policy alternatives that could achieve that objective, it simply hasn't happened as quickly as all of us would like. And I don't have a silver bullet to this problem, I have to admit. Sitting through this discussion and seeing it, I think we're probably due for another evolution of this. We'll probably see some more incentives either put on the table or addressed in some way. I don't want to go down the path of forbearance, and that is saying that banks should be allowed not to record the losses. I think you have to record the losses from the accounting perspective. But I don't think that in terms of the effect of restructuring these programs, it has been as successful as we would like. I'd also have to just throw something on the table for consideration, and that is, in our society, we had, over the last 10 to 15 years, promoted home ownership, possibly to a level that wasn't sustainable. And i.e., we've said the dream for every American should be to own their own home. Well, maybe in terms of that being the American dream, we need to either modify that view, that we need to get consumers to the point where they could first afford that, and then once they get into that position, then they could sustain home ownership. So I do think there needs to be a little bit more rethinking. If you look back to the loans that were made, no interest, low doc loans, I mean, who in their right mind would actually do that type of lending? But it happened. There was an insatiable appetite for that type of product in order to securitize, keep the securitization vehicles going, and so we produced it. But at its core, it probably had a fundamental flaw that was based on who we think should own homes. And I'm not here to make a social or political statement on that. I'm just saying from a reality-based perspective, maybe some of those loans shouldn't have been made to begin with. So I'd hope that the programs would be, they have not been as successful as we all. I think some of the fundamental changes will need to occur is we'll have to address the second mortgage issue a little bit more directly. I think at its core, we will still see a certain reluctance on the part of institutions to take write-offs in cases where, they think there could be a recovery. And so, that is part and parcel of the problem. Okay, well, this has been helpful for me, but let's take, you leaving or are you going to give me a question? Maybe.
I'd like to ask a question.
Okay.
You just touched on the no documentation loans.
Oh, yeah.
It seems like that the investors and the rating agencies and the regulators all sort of didn't catch on quick enough that as the banks moved into these, or lenders moved into this market, what would the result in the increased risk level would be. And I was curious how all that happened, how that there was no recognition, even by investors or by the rating agencies or by the regulators, why there wasn't a more of a reaction to this, moving into this market.
Okay, that's a very fair question. And in terms of where the majority of your low doc, no doc loans occurred, I would say, for the most part, that was a Western United States type of issue. And we saw in California where, again, asset prices were inflated or increasing. The sky was the limit. And I think we bought into the prospect that there could not be a reduction in the price of real estate properties in, for example, California, Arizona, and Nevada. I mean, there was just so much growth economically. And so the reality is when you're dealing with asset appreciation, you have to determine when you take, I guess in the Greenspan parlance, it was, you're supposed to take the punch bowl away from the party, okay? Well, there's a certain element of our society, and you can imagine how this works. You've got developers out there who are saying, I got this property's gonna have a golf course, it's gonna have this, it's gonna have that. I've got, you know, so much in terms of pre-committed sales. I've got all these things, all the positives that support these properties are such that if you're the one who says, well, I still think they should put some money down, I still think you need full documentation of their earning capacity, I still think you need just to make sure we have a security interest, all of that documentation pulled together before, you're viewed as an impediment. And it's interesting, and I'll probably regret the statement, the same element that's criticizing us now, or let's just call that the political element, that says you should have been on the job, you should have been doing this, you should have been that. Guess who's the proponent of a lot of these development activities when they're going on? You get, you know, I have a constituent in my district who's doing this, he's a developer or she's a developer, and why are you holding up what is economic progress in my district? So you get it both ways. And I think as a regulator, the saying no is something that you get comfortable with, but you have to do it at times where it is difficult. And I think with the low doc, no doc, I think we'll have to take one on the chin. Maybe we should have stood up a lot sooner and said that, you know, these loans were ill-advised and these loans were things that we were going to criticize bank management for making. But at the time, I could tell you they were all the sort of loans that were based on this particular individual as an entrepreneur. He or she is in the IT area. They've written some software that's going to be, you know, the next best thing. They've got Google. They've got some other people who are interested in them. It was all the promise of the future realized today. And I think that's what you had in the low doc, no doc. You had that in the valuation of the properties. You had that in the assessment of the borrowers who were going to be making these payments. And as we saw, the first hiccup that occurred in the economic cycle was they walked away from those properties. The developers didn't bring those to market. And as a result, I think there is a little bit of ribbing that we need to take as regulators on that point. And I stand ready to say we probably won't make that mistake again, but I have to think forward and say, you know, we're not going to be able to cover all risk and all exposures, so we have to address the known risk, obviously, and we have to start thinking a little bit more outside of the box, like if in fact this action occurs, what could potentially go wrong. But in the final analysis, this is America. And unlike other parts of the world where I've visited, our country, our citizens tend to be fairly innovative in comparison to others. We tend to be leaders rather than followers. So we tend to be those who are not confined by the past. We normally think of the future. We normally think of what could be, not what is. And so we tend to be fairly optimistic. And that permeates our business transactions. That permeates the types of things that we tend to be fairly innovative. I don't find that type of innovation in some of the other trading partners that we have, although what they may be better at is taking what we come up as an innovation and bringing that to a commercial outcome. Well, the reason I say that is that we tend to be the company that creates credit default swaps. We tend to be the country that creates low doc, no doc loans. And I don't expect financial engineering to slow down because of this particular setback, if you will. I think there'll be more of it. I think we just need to be more vigilant and say, you know, maybe based on this most recent experience, that's not the best way to do this. And so we'll put some blinders on, we'll put some governors on the engine of innovation, but we still want to stimulate innovation because that's what makes our economy grow. The job creation in our country is not done by the largest companies, as you know, it's done by the smallest companies. And the loan growth is generally going to be in areas where we have small business lending done. So we still want to encourage that type of development. We want to encourage that type of thinking. We just have to do it in an environment that's a little bit more safe, if you will, from a lending standpoint. And on that point, I'm looking forward to a lot more of this thinking as we come out of this crisis and as we learn going forward is that let's not stifle innovation simply because of this. Let's make smarter decisions. And from a regulatory standpoint, my job is to look at risk a little bit more differently, not just because it hasn't happened in the past, but what could happen. And that's what I think the brave new world holds for supervision, regulation, and the economy. With that said, I'd like to thank you for your time, your attention, and very much your questions. And if I have another opportunity to come back before this crowd, I would greatly take it. So again, thank you very much.
Thank you, Arthur. That was splendid. And I have to say, as a native New Yorker and adopted son of the Midwest, I'm comfortable with pointing a finger to the West Coast. In addition to this morning's presentation, Arthur's going to be spending some time with our students and faculty during the day, talking with us about some of the topics that he mentioned this morning, as well as spending some intensive time with our accounting faculty and students. Coincidentally, our Small Business Development Center is hosting a lenders conference this morning, and when we mentioned that to Art on the way in, the Small Business Development Center that is headed by Qua Mister, Art mentioned that he's maybe interested in stopping in on that to get some insight about how small businesses are liquidity that's opening up for small businesses as well. So we're pleased to have him participate in that event as well. I want to thank everyone for attending today's presentation and discussion. I want to thank also accounting professor Greg Sierra, who worked for Art before coming to SIUE, for his help in securing Art's presentation today. Also want to mention that Art's talk will be available on an RSS feed that will be available through the School of Business website, Elizabeth? It'll be available through the School of Business website later today, so faculty, students, and guests from the business community, if you wish to refer back to Art's comments, please look for that link on our website. And finally, let me thank and ask you to help me thank again Art Lindo for sharing his day with us. Thank you, Art. And we want to wish everyone a great day and a great week. Thanks for being here today.